Hi everyone. I hope everyone is fine. Welcome to our channel. If this is the first time you come to our channel, please watch our previous videos, then you will understand this topic well. I will leave those videos and playlist links in cards. Okay, without wasting our time, let's get into the topic. Here is the topic. Welcome back to Hope Pips, your ultimate destination for mastering the financial markets, decoding complex price action, and achieving consistent profitability across all trading domains. If you are new to the channel, make sure you hit that subscribe button, turn on the notification bell, and smash the like button because today we are breaking down a highly institutional strategy that will completely revolutionize the way you look at charts. In this training video, we are going to pull back the curtain on one of the most powerful combinations in technical analysis, pairing structural trend lines with raw trading volume. By combining these two independent variables, you gain the unique ability to track exactly where institutional market participants, the big banks, hedge funds, and market makers, are deploying their capital. When you can spot where the smart money is entering the market, you immediately shift the odds in your favor, transforming your trading from a game of guesswork into a system of high probability precision. The beauty of the methodology we teach here at Hope Pips is its universal application. Everything we cover in this masterclass works flawlessly whether you are trading crypto assets like Bitcoin and Ethereum, blue chip stocks, equity indices, or major Forex currency pairs. Why? Because market psychology, price action dynamics, and volume metrics remain completely consistent across every single asset class. Price moves due to imbalances between supply and demand, and volume tracks the footprint of the capital creating those imbalances. Before we dive deep into the charts and examine live trade examples from our own repository, we need to ensure everyone watching has a rock solid foundation. Let's start by reviewing the fundamental mechanics of trend lines so that no trader is left behind. Foundational mechanics of trend lines in bearish environments. Let's map out the structural architecture of a market in a clear, sustained downtrend. In a bearish environment, the market does not move in a straight line downward. Instead, it moves in a series of jagged waves, consistently printing a sequence of lower lows and lower highs. Each time the market attempts to rally, it fails at a lower point than the previous rally, indicating that sellers are aggressively overwhelming buyers at cheaper prices. To map this structure visually on your charting interface, you want to identify the prominent swing high points. By drawing a line that connects these consecutive peaks along the top of the price action, you establish a bearish trend line. This line serves as a dynamic ceiling of resistance. As long as the price remains below this trajectory, the bearish market structure remains completely intact. For retail traders, these trendline touchpoints present prime opportunities to scout for short positions or sell entries aligned with the dominant market momentum. However, a major trap that many novice traders fall into is entering a trade blindly the exact moment price taps the trend line. At Hope Pips, we advocate for patience. You must always wait for explicit candlestick confirmation. When the market approaches your dynamic resistance, you need to see clear rejection signals, such as bearish engulfing patterns, shooting stars, or long upper wicks. These structural footprints prove that the resistance level is actively defending itself, and that sellers are stepping back into the order book. If you fail to wait for this verification, the market can easily burst right through the level, triggering your stop loss and leaving you trapped in a devastating fake out. What happens when the price definitively pierces through this dynamic resistance? A clean, authoritative breakout above a bearish trend line serves as an early warning signal that the market environment is shifting. It indicates that the prevailing downtrend is exhausting its momentum and a transition into a fresh bullish uptrend may be underway. But a downtrend offers a second, often overlooked visual boundary. You can also construct a secondary trend line along the bottom of the price action by connecting the consecutive swing low points. When price descends to interact with this lower boundary, it creates a baseline where counter-trend buyers might briefly step in. This opens the door for aggressive traders to execute long positions against the dominant downward trend. At Hope Pips, we must emphasize that counter-trend trading carries an elevated risk profile. You are actively stepping in front of a high-speed freight train. If you choose to execute a trade against the primary macro direction, your operational thesis must be entirely different. These must be rapid, sniper-like executions where you capture a quick corrective bounce and exit the market immediately before the broader selling pressure resumes and traps your capital. Practical application: the dollar-yen bearish reversal. Let's bring these concepts to life by examining a structural setup on the US dollar to Japanese yen currency pair, commonly referred to as USD-JPY. Imagine a scenario where the dollar yen has been locked in a prolonged multi-week decline. By evaluating the macro swing highs, you can cleanly draw a downward sloping trend line connecting the two primary peaks of the bearish cycle. The market is respecting this boundary, keeping retail sentiment heavily skewed to the short side. Suddenly, market conditions shift. Instead of failing at the trend line, the price accelerates upward, reaching the dynamic resistance with a powerful, large-bodied bullish momentum candle. Not only does it break the line, but it also prints a fresh higher high on the chart, systematically violating the established bearish sequence. This structural shift provides an objective confirmation that the macro bias has officially flipped from bearish to bullish. As disciplined traders aligned with the Hope Pips framework, you no longer have any business looking for sell entries on this asset. Your framework must adapt immediately. With a newly established bullish bias, your objective now shifts to identifying high probability long opportunities by dropping down to lower intraday time frames to timing your entries on subsequent structural pullbacks. Foundational mechanics of trend lines in bullish environments. Now let's flip the script completely and analyze the structural architecture of a market in a healthy, sustained uptrend. In a bullish environment, price discovery moves upward through an orderly progression of higher highs and higher lows. Each retracement is cut short by eager buyers who are willing to step in at higher prices than before, signaling robust underlying demand. To properly map an uptrend, your focus must shift to the bottom of the price action. By drawing a line that connects the consecutive swing low points, you construct a bullish trend line. This line operates as a dynamic floor of support. For systematic trend followers, this boundary represents an optimal area to hunt for long positions, allowing you to ride the broader wave of upward momentum. Just as we outlined in the bearish section, a clean break beneath this dynamic floor of support is a critical structural event. If the price closes authoritatively below your bullish trend line, it serves as a glaring warning sign that the uptrend is breaking down, potentially marking the genesis of a fresh macro markdown phase. Additionally, within an established uptrend, you can draw a secondary trend line along the top of the price structure by connecting the consecutive swing high peaks. This upper channel line can be utilized to execute aggressive counter-trend short entries when the price overextends into the upper boundary. Once again, the team at Hope Pips wants to reiterate that counter-trend trading requires advanced risk management. Because you are trading directly against an aggressive bullish tide, These positions must be handled with extreme tactical agility. Secure your profits quickly, move your stop losses to break even rapidly, and do not overstay your welcome, or the dominant buyers will quickly run over your position. Case Study 1: The Tesla Confluence Strategy. To illustrate how these structural concepts manifest in real market environments, let's dissect a highly lucrative long position that our team executed on Tesla stock. When analyzing the asset's structural history, we identified a series of sharp historical reversal points that established a clear horizontal support and resistance zone, which we call an SR zone. Separately, by connecting two prominent macro swing lows, we projected a clean upward sloping bullish trend line across the chart. The real magic happens when these two independent technical tools intersect on your chart. This intersection creates what we call an area of confluence. Confluence occurs when multiple independent analytical frameworks point to the exact same price coordinate on a chart. When the price of Tesla retraced down to test this specific junction where the horizontal SR level and the ascending trend line crossed, it generated an exceptionally high-quality long trade setup. When we refer to a trade setup as high quality at Hope Pips, we mean two specific things. First, it possesses a statistically superior probability of producing a sharp positive reaction. Second, and more importantly, the resulting price expansion is highly likely to travel a significant distance. This expands your potential risk to reward ratio, allowing you to capture maximum profit while maintaining a highly contained stop loss. When Tesla's price dropped into this confluence zone, the technical evidence arrived in three distinct stages. First, we observed multiple daily candles printing exceptionally long lower wicks directly inside the horizontal zone, showcasing an immediate failure by sellers to push the price lower. Second, a powerful daily candle reacted precisely off the ascending trend line, validating its structural relevance. Third, the asset experienced a sharp gap down at the market open. In professional price action analysis, an abrupt gap down into a major historical confluence zone often indicates that the asset has become irrationally underpriced relative to its true immediate value. This creates a powerful market inefficiency, drastically increasing the probability that buyers will step in to aggressively fill the gap and drive the asset back toward fair market value. Once we accumulated this confluence of evidence on the macro chart, we didn't just buy blindly. We transitioned down to lower intraday timeframes to locate a localized trend change confirmation, ensuring a sniper entry with minimal drawdown before riding a massive wave of upward expansion. Case Study 2: The Block Stock Trade Replication. Let's reinforce this exact compounding framework by reviewing another high probability trade we executed on blocking stock. The asset was in a well-defined macro uptrend, establishing our core directional bias. We wanted to trade exclusively in harmony with the dominant buyers. First, we mapped the historical price peaks and valleys to isolate a vital horizontal SR zone. Second, we connected three distinct structural swing lows to form our ascending trend line. Remember this core rule: the more times a trend line successfully repels price without breaking, the higher its psychological and structural validity becomes across the market. As Block's price began to retrace, it headed directly toward our area of confluence, the exact location where our multi-touch trend line perfectly intersected our horizontal support level. Just prior to hitting this zone, the asset printed an inside bar pattern followed by a micro higher low and higher high, confirming that institutional accumulation was already beginning to simmer beneath the surface. When the price finally entered the core confluence zone, the immediate price action delivered two undeniable signals. First, the asset printed an elongated lower wick, providing absolute confirmation that major buyers were stepping into the order book with significant capital. Second, much like the Tesla setup, the market delivered a sharp gap down directly into the structural floor, rendering the asset temporarily underpriced. Recognizing this imbalance, the Hope Pip strategy was deployed flawlessly. We moved to our lower execution timeframes, waited for the localized market structure to break to the upside, and triggered our long position, capturing a highly profitable move as the market aggressively corrected its pricing inefficiency. Let's see advanced multi-timeframe integration, the Bitcoin blueprint. Now let's elevate our tactical approach by exploring the powerful world of advanced multi-timeframe analysis. To do this, let's break down a trade we took on Bitcoin using the 12-hour chart. Bitcoin has been putting on an absolute clinic with its explosive upward rallies. But for traders who truly understand advanced price action, this massive expansion was visible weeks before it actually materialized on the public's radar. By evaluating the macro 12-hour chart, Bitcoin was clearly locked in a massive uptrend. Our core objective was simple: align our capital with the dominant trend. By analyzing the historical price geometry, our previous trend lines cleanly mapped the market's boundaries. The moment those older lines were broken, they perfectly forecasted the next major leg of expansion. As the market completed its latest impulse, we mapped a major horizontal SR zone based on critical historical pivot points. Simultaneously, we connected two major swing lows to establish our primary ascending trend line. When Bitcoin began its corrective phase, it moved directly toward a massive confluence matrix. This specific zone was reinforced by three independent structural layers: the historical horizontal SR zone, the primary ascending trendline floor, the backside of a previously broken macro resistance trendline, which was now acting as a fresh support floor. When Bitcoin's price hammered into this multi-layered confluence zone, it printed a prominent 12-hour long wick candle, confirming institutional interest. However, a major lesson we teach at Hope Pips is that a macro long wick candle isn't enough for a professional execution. Even if a level looks incredibly powerful on a 12-hour chart, the immediate lower timeframe price action is still technically in a moving downtrend. The market can easily pause at your level, print a deceptive wick, and then aggressively break straight through to the downside. To protect our capital, we put the 12-hour chart on our left screen and opened the 1-hour execution chart on our right screen. The exact confluence zone from the 12-hour chart was mapped onto the 1-hour time frame. By analyzing the internal mechanics of the 1-hour pullback, we were able to draw a tight, localized descending trend line directly over the corrective wave. The moment the 1-hour price action broke cleanly above this micro trend line and printed an authoritative higher high, it provided objective confirmation that the localized corrective phase was over, and the next macro leg of the 12-hour uptrend had officially commenced. At this point, different execution styles come into play. Aggressive breakout traders will enter the market the moment the line cracks, while conservative traders will wait for a structural retest of the breakout key level. Regardless of your preferred style, the elite traders at Hope Pips take this a step further by dropping into even lower execution timeframes, such as the 5-minute or 1-minute charts, to integrate real-time volume metrics and order flow delta for pinpoint accuracy. This precise methodology allowed us to capture the entire move long before the macroeconomic news and the presidential election drove Bitcoin to fresh all-time highs. Let's talk about the unlocking order flow introduction to volume tools. Now that we have completely mastered structural trend lines and multi-time frame correlation, it is time to supercharge our trading edge by pairing these concepts with institutional volume metrics. Pure price action shows you where the market has moved, but volume reveals the intent and strength behind those movements. Volume is a core component of the broader concept known as order flow analysis. By utilizing advanced volume tools, you remove the guesswork from your charting. You no longer have to wonder if a breakout is real or fake. Instead, you can clearly see whether the big institutions are actively funding the move or if retail traders are being lured into a classic bull or bear trap. The very first institutional volume tool we must add to our charting arsenal is the cumulative volume delta, widely known as the CVD indicator. Before we break down the exact mathematical logic of this tool and show you how to apply it to your charts, we want to hear directly from our community. What specific trading strategies or technical tools do you want the Hope Pips team to break down in our next masterclass? Are you struggling with liquidity sweeps, order blocks, or fair value gaps? Let us know in the comments section below right now. While you are down there, please remember to hit that like button to support our team's mission to deliver free institutional grade trading education. To load the CVD indicator on your charts, navigate to your charting platform's indicator tab, type cumulative volume delta into the search bar and select the metric. It will populate as a separate oscillator tracking directly beneath your main price action screen. The CVD indicator functions by meticulously analyzing the aggressive buying and selling volume occurring on the lower microscopic time frames within each individual candle bar. By subtracting the aggressive market sell orders from the aggressive market buy orders, it plots the net directional volume pressure over time. Okay, I think you understand the CVD. Then let's move to next step. That is advanced volume divergence, the Coinbase execution. The absolute most effective way to utilize the cumulative volume delta indicator is by actively scanning for structural divergences between price and volume delta. To understand how this works, let's dissect an exceptional 4-hour trade setup we executed on Coinbase stock. Initially, Coinbase was locked in a clear markdown phase. However, the market structure shifted dramatically when the asset formed a distinct higher low, followed by an aggressive higher high. This structural shift signaled an official trend reversal from a downtrend to a fresh uptrend, giving us our core directional bias. We were strictly looking to buy pullbacks. By connecting the newly formed swing points, we constructed our primary ascending trend line. Furthermore, we noted a powerful area of confluence formed by the intersection of our new trend line and the backside of the previously broken bearish resistance line. When Coinbase pulled back to test this dual-layer support zone, it printed an inverted long wick candle accompanied by an immediate shift in candle color, followed by a second traditional long wick rejection candle. This clustering of price action signals confirmed that the confluence zone was acting as a formidable floor. But here is how we took this trade to an elite level at Hope Pips. By looking down at the cumulative volume delta indicator, we spotted a massive bullish CVD divergence. While the price of Coinbase was successfully holding a structural higher low on the chart, the CVD indicator had aggressively driven lower to print a prominent lower low. This structural divergence reveals an incredible secret about market mechanics. The lower low in the CVD indicator proves that an immense amount of market selling pressure was being thrown at the asset. Yet, despite this heavy selling volume, the actual price of Coinbase refused to break down and instead held a higher low. This tells us that major institutional buyers were sitting at our confluence zone, utilizing passive limit orders to completely absorb every single sell order entering the market. This is the definitive footprint of institutional accumulation. Armed with this volume confirmation, we dropped to our lower intraday time frames, timed our entry, and executed a long position. The validity of this setup was instantly proven as the market opened with an explosive gap up, followed by a massive uninterrupted rally to the upside. If you want to utilize the exact professional charting platform that our team uses to track these volume metrics, make sure to click the link provided in the description box below. Okay, big boys, we will talk about short trading mechanics now. Let's unwrap it now, the euro dollar breakdown. To ensure you can trade any market condition, let's reverse our entire framework and apply this institutional trendline and volume strategy to a short or sell position. We will analyze a live trade setup executed on the euro to US dollar currency pair, commonly known as euro USD, using the 4-hour chart. The euro dollar was locked in a clear macro markdown phase, printing a consistent sequence of lower lows and lower highs. Because the macro trend was heavily bearish, our objective at Hope Pips was to position our capital exclusively alongside the dominant sellers. A temporary counter-trend pullback began to materialize on the 4-hour chart. To track the geometry of this retracement, we drew an upward sloping micro trend line beneath the ascending candle lows. The upward move was incredibly short-lived. The price aggressively collapsed through the trendline floor with a massive large-bodied bearish momentum candle. This clean breakdown provided absolute structural confirmation that the temporary pullback had concluded and the broader macro downtrend was ready to resume. Next, we mapped our key historical pivot points to identify a crucial horizontal SR resistance zone. The price moved up slightly to retest this zone, printing a prominent upper wick rejection candle followed immediately by an inverted long wick candle that initiated a candle color change. This clustering of bearish signatures confirmed that sellers were aggressively defending the horizontal ceiling. Following our strict multi-time frame checklist, we did not enter blindly on the 4-hour chart. We dropped down to the 15-minute time frame to inspect the internal order flow mechanics. On the 15-minute time frame, the exact resistance zone from our 4-hour chart was mapped across the screen. Beneath the localized 15-minute corrective bounce, we drew a clean ascending trend line. The moment the 15-minute price action broke beneath this trend line, it provided our first structural confirmation that the short-term buying pressure was entirely exhausted. To locate our precise entry point, we turned on the session volume profile tool. We identified the point of control from the previous day's trading session, which was plotting as a major horizontal barrier directly above the current price action, operating as a clean resistance level. The euro dollar rallied slightly to test this previous session POC and was sharply rejected twice, printing two clear upper wicks. This gave traders two clear execution pathways. You could trigger a short position the moment the price printed a lower low following the second POC rejection. Or you could draw a secondary micro trend line beneath the rejection candles and enter short the exact moment that internal line broke down. Both entry methods were highly valid and led to an incredibly clean downward expansion that hit our profit targets with minimal drawdown. What we have covered in this comprehensive masterclass today is truly only scratching the surface of what is possible when you learn to read professional price action alongside institutional order flow and volume metrics. The markets are constantly evolving, and as retail traders, our greatest edge lies in our ability to remain disciplined, patient, and completely aligned with the footprint of the smart money. If you want to take your trading education to the absolute next level and learn our most advanced proprietary price action systems, risk management frameworks, and live order flow strategies for trading crypto, forex, and equities with sniper-like precision. Make sure to click the link located directly below this video or head over to our official channel at Hope Pips. Our specialized videos are carefully structured to take you from a struggling retail trader to a completely self-sufficient, well-funded market professional. We want to thank each and every one of you for spending your valuable time with the Hope Pips team today. Your dedication to mastering this craft is what drives us to continue producing high quality, actionable educational content week after week. Before you close out of this video, please make sure to smash that like button, leave a comment detailing your favorite strategy from today's lesson, and share this video with your fellow traders. Trade safely, protect your capital at all costs, stay locked into your execution checklists, and we will see you all in the very next episode. Goodbye for now.